We're going to talk about the foundations of investor networks. When we work with investors, I think those of you who have done a little bit of this, you very quickly realize that working with investors is a relationship-driven, high trust, high touch game. Okay, so the core mechanic of working with investors is relationships and building trust. There's simply, I don't think, any way of getting around this besides maybe things like branding and thought leadership, which actually, if you think about it, are also ways of forging that trust to begin with. When I see things like this on the internet, this is very common on LinkedIn, other forums, people who post these lists of active family offices, the most active angel investors, medtech founders, VCs who are actively investing. This stuff is clickbait. I honestly don't understand why it does so well. It's sexy, but it's also reductive. If it was that easy to go out and just download some lists and automate and reach out blindly to investors and get them to follow your deal flow, this is not the answer, right? I'm very skeptical. I don't think it works. Believe me, if there's a way that this works, I would have found it already. Okay, so I'm just putting this in perspective. Very easy to scale, but also potentially equally ineffective. What actually is the answer? So how do you go about thinking about building a strong, healthy investor network? I like to go back and think about this from the lens of investor psychology. Let's start out with investment thesis. I'll start out by saying that every investor has a thesis. You, as more experienced investors, probably have more clarity on it. But every investor, even if they're starting out, they will have some flavor of deal that they're interested in and others that they're not, right? Even if it's subconscious, everybody will have some things that they favor and some biases. The simplest way to frame out what this investment thesis is a confluence of three things. Number one, what sector or domain do you invest in? What geography does an investor deploy capital into? And thirdly, what stage of companies do they invest in? When you think about these drivers for an angel investor or an investor, somebody who's potentially an LP into your syndicate, what is driving those decisions? In terms of sector, it has to do with familiarity, right? Somebody who has a background in healthcare or medical tech or pharma, they're much more likely to be interested in investing in deals in that space. Why? Again, it's just familiarity. It could be due to interest or affinity. If an investor has made money in crypto, they're simply more likely to be interested in investing in Web3 companies, for example. For geography, the earlier stage that investors invest in, the more localized that capital is. So from the perspective of you all as potential syndicate leads, if you are investing at pre-seed up to seed stage, intuitively, you need to start in your own backyard. Why would an investor from a whole other country or region look at a particular market if they have no particular affinity to it? It just doesn't make sense intuitively that we know that. The only reason that we could break this rule is if maybe somebody is part of a cultural diaspora. So if you are, for example, a Indian angel investor living in the US, you're part of the Indian diaspora, you have a connection to your home country, you would look at Indian deals, right? That's intuitive. Or maybe between where you're at, there's a natural economic corridor with another region, let's say in North Asia between Japan and Korea, as an example. But other than that, it's a crapshoot to think that you are able to find investors for your deal flow in a particular market in a whole other part of the world where there's no connection. Focus in your backyard. And then the last thing, the stage investors invest in is primarily a function of capital. Individual angel investors, they're writing 4 to 5 figure checks. They're more or less relegated to pre-seed up to seed stage. If you're building out your own syndicate, doing deals, you at six-figure range, you're probably able to flex up to Series A. And this is something that you can offer to your investors, right? This is a stage access that they would not otherwise be able to get into. So when you are thinking about building your investor network, thinking about your investors in this lens, okay, profile them very simply from the background to based on what you think their thesis is, doesn't match yours, okay? And you were trying to find that alignment and building your investor base around that. There's something I call the 70-20-10 rule when it comes to this investment thesis. And the rule simply says that 70% of the investor interest is going to be driven by the sector or domain, 20% is going to be the geography, and 10% is the stage. So you get 90% of the answer. If you're trying to profile an investor to see their fit with your syndicate, 90% of your answer come from sector and domain. So if you can figure those things out, you get a pretty good answer already. So how do you do this? There's this great tool out there. It lets you understand this. If you haven't already seen this, you can sign up. It's called LinkedIn. Simply from looking at somebody's background, where they've worked, which industries, where they've lived in the world, it's going to tell you your answer. Okay, so just use this very simple rule, apply that, and be targeted with investor outreach. This is my message to you. When individual investors go into venture, they effectively have three options, three vectors for how to invest. Number one, they can deploy capital as an independent angel. That's the first column. They can choose to be part of syndicates and to see deal flow that way. This is the second row. And then they can also choose to participate in VC funds. There's a lot of detail here on this slide. I don't want to dwell and spend too much time. Anyway, the slide will be made available to you so you can look at all of this. But what I want to net this all off and communicate to you is how do we position the syndicate to potential investors? Okay, if they're looking at the world of venture, they have these three things. The first thing that you want to do is to negate the VC fund for honestly very practical reasons. Why? Because the VC fund is a big ticket blind pool vehicle on the very small range, on the lower end, for a deal, for a fund that is maybe even $10 million, which is pretty small. It's going to be a minimum ticket of $250,000. So how many angels have the ability to invest that much? Actually, not that many. So it immediately disqualifies 99% of angels. And they also lose the choice of portfolio construction. They don't have control of what they want to invest in. And that's important for a lot of angel investors. So immediately, it's a non-starter. And so the first thing is negate the VC fund because it's just not relevant. So why are we even talking about it? Which means that the choices come down to being an independent angel doing direct deals or following the deal flow of a syndicate. And here I say, it's not an either or. You don't really have to choose. You can have the best of both worlds, which means that then we want to make the argument for being part of a syndicate. And so what we say is, hey, you know what? By being part of a syndicate, you do get curation, access, and filtering benefits because we're doing the lift of finding deals, looking at all of this, screening all of this, and doing this work on the back end. We also do diligence. We package that up nicely, share it with investors, and so they get a benefit from it. It does vary with every single syndicate, but I tend to be a little bit more diligence heavy because I like to be able to stand behind the deals that I push out to my investors. There's a diligence benefit for being part of a syndicate because as a group, we're doing heavy diligence and sharing that. It does vary from group to group. So you have to decide what's the right balance for you. In both cases, whether you're doing direct deals or being part of a syndicate, you get decision control over your portfolio. It doesn't hurt you. And then there's a time saving. We're doing the heavy lift of packaging up all of these deals. There's a diversification benefit because for investors, for a fixed sum of capital, they get to spread their bets out into higher quality deals because we're seeing more. They get access to more deal stages. So there's benefits on both of those cases. The trade-off is this. If they're deciding to invest in a deal through a syndicate versus directly, there's going to be some fees and there's going to be an upside that they share in terms of carried interest. And that I leave to investors. I make the argument that, hey, if the deal is good enough, somebody's able to give me access, I'm happy to pay carried interest. I'm part of other syndicates and angel networks. And if there's a deal that I like and I invest, I have no issue paying the carry, but it's up to them. So this is how we present the options and how we argue for the syndicate over other choices. Now, I don't know about you all, but this is my inbox or LinkedIn on a random day. It's a constant bombardment of inbound, either investors looking for deal flow, other investors seeking capital, VC funds raising, some combination of all of this. The point of it is not to say that Jet is really popular. It's that it can be a really noisy place. And when you think about it, venture investing is not a hair and fire problem. Nobody has a burning hole in their pocket where they absolutely need to invest in a startup. They can absolutely just sit around and do nothing, and their life would not be worse off. Which brings me to this. Building out investor networks is an unscalable human problem. I don't think there's any way to get around it. I'm very happy to find a more scalable solution, but up to now, I think this is the reality. So my key messages here are this, right? Building investor networks is a people problem, not a technology problem. Investing is a people business and relationships business. So trust is our currency. I have met or spoken with every single one of my 1,400 plus investors in my network, zero exceptions. In fact, if I don't speak to anybody, if they don't book a call, I don't share my deal flow, right? I need to know who's on the other end because I want them to also trust me. Focusing on relationships first with your investors has the benefit of creating referrals, which you benefit from downstream. This is my $0 investor acquisition loop, right? I'm going to talk about this later in the next section. Remember, investing in startups is not a hair on fire problem. Nobody needs to invest in the startups. Doing nothing is just as easy. Having a syndicate platform, by the way, I'm making a distinction here on a syndicate platform separate from an SPV platform. Having a syndicate platform in the sense of having a UI where somebody can go to look at a deal can be double-edged. Having a UI is great, right? It presents information nicely, but it also adds friction for your investors in a way. You're telling somebody to go to some platform and log in for some activity that they haven't done for the last 4 months. So it adds a lot of friction, right? Where's this website? How do I find the URL? What's my password? All of these just basic fundamental problems get in the way. Doing this unscalable thing, right, of speaking to your investors, making sure that they're engaged one at a time is to ensure that they will look at your deal flow when you're ready to go out to market. Okay? If you don't do it, you're potentially setting yourself up for failure in that you've built a very large mailing list, but when you push out a deal, you get zero engagement from it just simply because people don't know you. So I'm just going to say this categorically. I believe that these LinkedIn investor lists relying on mass full outreach, it just doesn't work. And if there's some way to automate and scale it, of all people, believe me, I think I would have found it. Number 4, every operating syndicate, once you build your critical mass, your base of investors to get deals done, your bottleneck actually shifts to deal engagement. It's not just my syndicate. Every syndicate that I know that operates beyond like minimum scale has this problem. You do need numbers on your side, of course, right? You need enough investors to reach out to share your deal flow. But my point is having a really large mailing list doesn't matter if everybody is switched off. Doing the one-to-one onboarding is the key to unlocking scalability. I've talked to every single one of my investors before I share deal flow, right? Unconditionally. Why? I spend 30 minutes to meet with every investor upfront. I think of this as, in a way, an investment. The ROI from this time basically is making sure that over the course of 2 or 3 years, if they see 10 or 20 of my deals, they are going to give me the attention and mind share because it feels like it's getting an email directly from Jed and I'm sharing this information. Doing this is also about scaling fundraising. Today, when I push out a deal and nurture interest and close capital, 95% of the time, it's a self-service process without needing to talk to investors one-to-one. So high level, with 1,400 investors, my average engagement rate on a deal is 15% of the pool, which means on every deal, I have 200-ish investors that have expressed interest in some form. If I have a 1-month deadline to close a deal, it's simply not possible to talk to investors one by one, to educate them, nurture the interest. So we need a mostly self-service process. And part of that equation is having the onboarding upfront. What I'm showing here on this slide is data from my CRM. The blue line shows the number of investors subscribed to my deal flow. And there's a time axis on this bottom. The reason that I put this data together was that when I started doing deals initially, I noticed that my investors were offering to make intros to others. They were sharing my newsletter with other investors because I had random people requesting access to my data room. And I did understand, okay, who is this person? How did they find out about this? The only logical reason is that they had seen the deal from somebody else. Because of this, I wanted to go back and figure out if there was an actual pattern to this or if it was purely noise. So I went back to my calendar, looked at my inbox, tried to figure out mapping activity against this time scale. And the story it tells is this: I launched my very first deal after building my original base of investors in May of 2020, and I ran the syndicate itself in July. So I was more active with updates, sharing information with investors, following up with people, and all of these things. In July, I announced the second startup and ran the syndicate in October. And then we did startup number 3 towards the end of 2020. And then I did a syndicate for startup number 4 at the end of 2020 and into 2021. When we start mapping these patterns onto the growth of our investor acquisition, we start to see a correlation here between deal activity and referrals. So this is the pattern that I'm referring to. So this is the number one vector that I rely on to grow my investor network today. So in effect, at scale, without spending time acquiring new investors, simply from doing deals, focusing on being an investor, which is what we all want to do, you're going to naturally, organically acquire investors. The magic number where you start seeing this happen is 100. Once you have about 100 investors, that referral effect, which might be small, it might be 1%, 2% per deal, you'll start seeing noticeable, repeatable patterns. And this is where the gains start to stack up for you. And like I said, today, 100% inbound investor acquisition. I spend no time seeking out deal flow, seeking out new investors. I still do the onboarding calls when somebody wants to get access.